Today, we will talk about crude oil and its significance to investors. Crude oil is a naturally occurring liquid petroleum product composed of hydrocarbon deposits and other organic materials formed from the remains of animals and plants that lived millions of years ago. These organisms were covered by layers of sand, silt, and rock, subject to heat and pressure, and eventually turned into a type of fossil fuel that is refined into usable products, including gasoline, diesel, liquefied petroleum gases, and feedstock for the petrochemical industry. Crude oil is a non-renewable resource, which means that it can't be replaced naturally at the rate we consume it and is, therefore, a limited resource. Crude oil is typically obtained through drilling and is usually found alongside other resources, such as natural gas and saline water. After extraction, crude oil is refined into various products for sale to consumers. Its price can have ripple effects through the broader economy, with rising oil prices leading to higher gasoline prices, shipping costs, and increased input costs for producers. Crude oil prices are driven mainly by the principles of supply and demand. Crude oil was first discovered and developed during the Industrial Revolution and became essential during the 19th century. Today, the world's economy is heavily dependent on crude oil, and the demand for these resources often sparks political unrest. The United States, Saudi Arabia, and Russia are the leading producers of oil, and the market has seen significant changes due to technological advancements and global warming concerns. Petroleum is a more general word that refers to crude oil, the raw, unprocessed oil that is extracted out of the ground, and other petroleum products formed from refined crude oil. Petroleum products include diesel, gasoline, fuel oil, and more. Investors may purchase two types of oil contracts, spot contracts and futures contracts. The price of the spot contract reflects the current market price for oil, whereas the futures price reflects the price that buyers are willing to pay for oil on a delivery date set at some point in the future. Futures prices for crude oil can be higher, lower, or equal to spot prices. The price difference between the spot market and the futures market says something about the overall state of the oil market and expectations for it. Backwardation and contango are two terms used to describe the relationship between expected future spot prices and actual futures prices. Economists and experts are hard-pressed to predict the path of crude oil prices, which are volatile and depend on many variables. They use a range of forecasting tools and depend on time to confirm or disprove their predictions, and unforeseen factors like natural disasters, political events, or social upheavals can derail the most careful of calculations. Because crude oil prices constantly change and are typically more volatile than stock or currency prices, it is crucial for successful investors and traders to have good information sources that report on the many factors that can influence oil prices. The basis, or differences, between oil futures contracts and the spot market can be indicative of the near-term expectations of oil supply and demand. When futures prices are trading higher than the spot, it suggests that traders are willing to pay a premium for oil to be delivered at a future date and that expectations are that the market will improve. Crude oil prices and related market news are available online, often for free. For example, MarketWatch provides up-to-date price quotes, headlines, and commentary. OPEC membership is open to any country that is a substantial exporter of oil and shares the ideals of the organization. As of 2019, OPEC consists of 16 member countries, with the 5 founding members being Venezuela, Iran, Saudi Arabia, Kuwait, and Iraq. Here are 5 key takeaways. 1. Crude oil is a raw natural resource that is extracted from the earth and refined into products such as gasoline, jet fuel, and other petroleum products. 2. It is composed of hydrocarbon deposits and other organic materials that were formed from the remains of animals and plants that lived millions of years ago. 3. Petroleum is a more general word that refers to crude oil, the raw oil that is extracted out of the ground, and other products formed from refined crude oil. 4. Crude oil is a global commodity that trades in markets around the world, both as spot oil and via derivatives contracts. 5. Many economists view crude oil as the single most important commodity in the world, as it is currently the primary source of energy production. Hope this would help. Thanks for watching.